Welcome back, everybody. You came back. All right, we're Rodney Clements, your other training facilitator, and we're moving forward with the next webcast series, number 7. And it's subpart E, cost principles. So we'll be covering the general provisions and the direct and indirect cost. And the next segment, we'll go into the selected items of cost, which is kind of interesting. I think you'll find it pretty interesting. Some new things for us for our block grant recipients. And let's just to remind everybody that this is part of a webcast series. So this is segment 7. And so we have this broken up into, we're going to be covering the subpart E into 2 segments. So this is section 7, excuse me. And then the next segment will be 8, and we'll be covering the cost principles. So also want to remind everybody that we have some really great tools for you. Listed here, we discussed earlier, but we have the red line version for the 200 uniform guidance and the uniform guidance crosswalk for both the IHBG, ICBG. We have conforming amendments, which we're going to be actually taking a look at here shortly. And a lot of background implementation materials. And so as we go through this, we may reference some of these tools and have you kind of look at them. So just want to make sure everyone remembers that. So let's go ahead and dive in. And again, this segment is about looking at what are the changes that have been implemented with the new uniform guidance. Some things that are new for us that we didn't see. So I have to say, if you are not familiar with the A87 cost principles, if it's new to you, the former A87 is new to you, it's still going to be new to you. Unfortunately, we can't bridge that gap because we're really focusing to alert folks as to what changed and if there's any impacts that we need to be aware of. So we're going to be covering the basic considerations, 200, 400, 411, and then also short segment on direct and indirect cost, 412 through 417. So let's dive right in and see what has changed. So the first thing I'd like to do, just to lay a little bit of groundwork before we actually jump into the principles, we need to take a look at the program exceptions. So everyone, if you're going to go to your book, and in the document we're looking for is the conforming amendments sections. So we have copies of those for 1026 for the NAHASDA regulations, which describes the administrative requirements under NAHASDA. And we also have a document that is the 24 CFR 1003-501. It is also it's a section called applicability of uniform administrative requirements and cost principles. So we're going to look at both of those documents. When back in December, when the conforming amendments were published, these are the new conforming amendments. Prior to that, the references in our program regulations were referencing 24 CFR Part 85, or for the cost principles, it was referencing OMB A87 or 2 CFR 225. So effective December 7th, 2015, the amendments were made to conform to the citations for the uniform guidance. Okay, so everybody got that? You found that document? Okay, so we need to lay a little groundwork before we jump in. So if you look at, and this is pretty much verbatim the same language for IHBG, ICBG. So it says, with respect to the applicability of cost principles, all items of cost listed in 2 CFR Part 200, subpart E, which require prior federal approval, are allowable without the prior approval of HUD. So that's pretty earthy. We've had that along. This is the same language we had before. To the extent, and that's what you need to underline if you want to underline that in your text, to the extent that they comply with the general policies and principles stated in 2 CFR Part 200, subpart E. So that's what we're going to cover next, is what are those general policies and principles that we have to comply with to really accept, to really for the cost to be determined allowable. Okay, so everybody got that? Then it goes on to say, and are otherwise eligible under this part, and then underline this, it says, except for the following. So there are some exceptions. HUD is basically granting us prior approval on selected items of cost, which we'll be discussing later, except for these, okay? So let's take a look at what those are. There's a couple of changes for us. These two, right off the bat, the only change to point out to you here is under 436D2, the depreciation method for fixed assets shall not be changed without the approval of the federal cognizant agency. The only change there is, it used to say without the approval of HUD or the federal cognizant agency. So now it just says plainly just the federal cognizant agency. Next section, 441, fines, penalties, damages. Few little words changed in there, just to expand on that. I think the word other settlements was added in there, but substantially just the same. And then here now are the changes that became effective December 7th, 2015. New item of cost. So number 3, for both, and this one, number 3 is both for the IHBG and the ICDBG exceptions. So costs of housing, the depreciation, maintenance, utilities, furnishings, rent, housing allowances, and personal living expenses, regardless of whether reported as taxable income, is to the employees, is going to require prior approval from HUD. So we'll look at this selected item of cost later. It is, I think, imported for us from the I think probably from the Institute, the higher education. They're attracting professors, and so you sweeten the salary package and you provide cost of housing as part of that package. Nevertheless, we're going to see new items of cost that we hadn't seen before, and so this is one of it. And so again, HUD's making sure that everyone understands that this doesn't have prior approval. It needs to go to HUD for that prior approval process. And then the next one, 200-455, is organizational costs. Another new item of cost that also requires HUD prior approval, and it applies only to the ICDBG. So this is not a prior approval requirement for the IHBG, only the ICDBG. Okay, any questions on that? Sounds good? Okay. So that gives us the foundation. Again, what we're looking for is, when it says to the extent that they comply with the general policies and principles, that's the question I want to ask right now. What are those general policies and principles that we need to look at? So let's go to 400, to begin this. So what you'll see, if you wanted to follow along in your side-by-side document, you're welcome to do that. We have the side-by-side comparison document with subpart E. So if you want to do that, or if you'd rather just read through and follow along with your 2 CFR 200 document, that's fine. However you want to review that. So the first thing is a new provision in paragraph D of the policy guide. So it says the application of these cost principles should not require significant changes in the internal accounting practices of the non-federal entity. However, the non-federal entity should have the following in place. Accounting practices must be consistent with these cost principles and support the accumulation of costs as required by these principles. And importantly, the next thing is must provide for adequate documentation to support the costs charged to the federal award. And this really just fits with what we discussed under subpart D for federal management requirements, financial management requirements, support documentation. That's been with us all along. We always got to have support for every cost that we incur for the grant. Has to have supporting documentation so we know exactly what was purchased, what program objective it's serving, and for what what purpose and how much we spent. Paragraph E and G, a couple of new paragraphs in there in the policy guide here. In reviewing, negotiating, approving cost allocation plans or indirect cost proposal, the cognizant agency should generally assure that the non-federal entity is applying these cost principles. So whenever a tribe is putting together an indirect cost proposal, they have to mirror and be in compliance with the subpart E principles. Paragraph G, the non-federal entity may not earn or keep any profit resulting from federal financial assistance unless expressly authorized by the terms and conditions of the federal award. So, 2 new paragraphs. Again, these are just policy statements. Again, expanding on the language that was already there and making more clear, the intention of the policy. Okay, so let's go to 401. See what's, there's nothing changed in 401, but I just wanted to lay this groundwork in this slide because there's a change in the next section. But just to review, again, we're talking about what general provisions that apply. So it must be in determining, these cost principles apply and must be used in determining the allowable cost of work performed by the non-federal entity under federal awards. By the non-federal entity as a guide in the pricing of fixed price contracts and subcontracts where costs are used in determining the appropriate price. So again, what this is saying is if you are determining the pricing of fixed price contracts, subcontracts, you're doing cost estimates, and you would apply these principles in determining the appropriate price. So here's where 401 is where we have some new language. So where these cost principles do not apply. So first one, A, paragraph 3, fixed amount awards. So in the earlier section where we were talking about fixed amount awards, it's a new provision or contracting provision we have, it's a new manner of which we could receive awards from the federal government, or a pass-through entity may give that to their subrecipient. The cost principles do not apply. Because the main thing about fixed awards is it's not based on cost principles, it's we're giving you a flat amount of money to accomplish a particular objective. If you accomplish that work performance objective, if there's money left over, you keep that money. And as long as it's we can make those awards under the simplified acquisition threshold. And so what this is saying is if cost principles won't apply, we're not going to look at items of cost under that fixed amount award. It's not going to apply. We don't have to look at the cost principles to really make those determinations what cost is allowable or unallowable. Again, the focus is on the outcome. Did they achieve their performance? A5, new language, other awards where the non-federal entity is not required to account for the federal government, for actual costs incurred. And then paragraph C, if you go to appendix 8, there are I think about 30 some odd individual organizations that are nonprofit organizations who have specific exemption from the cost principles. So that's the changes for general provisions. Next section, 402. Not a big change, substantially the same. The only thing that was added in this paragraph is it says, the only thing added is the sum. So direct cost is the total costs are allowable direct cost plus allocable indirect cost minus applicable credits equals total cost. So just again, a lot of these changes are just minor tweaks, just to give us a little more clarification. So let's go to 405, allocable cost. I mean, you know that term, allocable. You have to deal with that a lot, right? That means, can this cost, it may be a good thing to purchase, but is it the right thing to purchase for this grant objective? And it's got to have a federal award cost objective that it benefits a particular benefit of a federal award objective. So not everything is everything. There's a lot of things that are allowable, but it may not be allocable to that particular grant, right? Okay, so the new language here that's added here is some criteria for how this standard is met. So this is what they've expanded the language on and added, that in order to meet the standard, you can determine that you met the standard if the cost is incurred specifically for the federal award. It benefits both the federal award and other work of the non-federal entity, and can be distributed proportionately using reasonable methods. So that's a really big thing with the cost principles, is everybody has to pay their fair share. Being able to distribute cost, allocate cost proportionate to the benefit that each program gets from that program, and is necessary to the overall operations of the non-federal entity, and is assignable. Okay, so here's kind of the new thing that's kind of interesting, new language in here. Regarding in paragraph C, discussing what are disallowed costs. So any cost allocable to a particular federal award may not be charged to other federal awards to overcome fund deficiency. We've known that to avoid restrictions that might be imposed by the federal statutes, regulations, or terms and conditions of the actual award. But here's now this exception, which is kind of interesting. It says we can shift costs that are allowable under 2 or more federal awards in accordance with existing federal statutes, regs, or terms and conditions of the federal award. So if I purchase a piece of lumber to build a house, and that is an eligible cost for both my IHBG grant and is also a cost for my ICDBG project, then I can say, I decided I want to now shift that cost and have that expensed out of my ICDBG versus my IHBG. So this is new language. It's kind of makes sure that you have some flexibility before you close out your books to shift costs. Some expanded language again on paragraph D under 405. So if a cost benefits 2 or more projects or activities in proportions that can be determined without undue effort or cost, the cost should be allocated to the projects based on the proportional benefit. And so here's the new language here that's just sort of, and they give the example, if not, the costs may be allocated or transferred to benefited projects on any reasonable documented basis. So one of the examples of that is IT costs. So how do we buy IT? It may be serving multiple federal programs. How do I allocate that cost so that each one is paying their fair share? What this is saying is it's on any reasonable documented basis. You have to have it written out in some sort of justification. I don't know, it could be this department has 20 employees, and this department has 5. There's a reasonable way to proportion those costs and IT costs. Continued, where the purchase of equipment or other capital asset is specifically authorized under a federal award, the costs are assignable to the federal award, regardless of the use that may be made of the equipment or other capital asset involved when no longer needed for the purpose for which it was originally required. So meaning, we're talking about equipment. At some point, we might be finished with that project, and we can dispose of that piece of equipment what this is saying is, at that time, I don't need to now allocate that cost to another federal program. So it would stay with the original program that we purchased it in. So that's kind of new expanded language. Okay, and then 407, if you look at 407, if you take a look at it, you can see there's a list about this long of things that now require prior written approval. Things that we didn't have before. So this will help us appreciate the clause that we have now in 24 CFR, not now, but we've had 1026 and also for ICDBG. The clause that where HUD is granting us for all of the items that do require prior approval, we are granted that prior approval through this language with those exceptions that we discussed. Any questions on that? Is that good? Okay. And then 200, 408 through 409, a couple of new sections added in here, just clarifying things that we already knew, but we maybe understood, but making it clear that we cannot charge cost above the statutory limit of the federal award. So if you have a $105,000 grant and we charge $120,000 to that, that would not be allowed. Where did you get that money? Where does that come from? Special considerations, 200, 409. So this just makes clear that there are certain provisions in the items of cost in this subpart E that are only applicable to certain non-federal entities. So for example, cost allocation plans, indirect cost proposals, interagency service, they're applicable only to states, local governments, and Indian tribes. So 409 just connects that link there. 410 and 411, again, just new provisions added in subpart E that clarify that if we have any unallowable direct or indirect cost, that if we have any, if we make a determination that there's an indirect unallowable cost, it must be refunded or deducted, including interest to the federal government, unless we have a federal statute or regulation that requires or directs otherwise. So, and then 411 is just saying, hey, if you have any, it's later determined that we have unallowable costs charged to the federal award, then that's going to have to be adjusted and refunded back to the federal government. So those are the new principles that are added in the basic considerations, cost principles. It sort of lays the foundation. So 413, here's a new section on direct costs. Paragraph C, the language was added here. And this is important only probably for tribes who have fairly a large number of federal awards that they're managing. They may have a front desk receptionist that's serving multiple programs. So this clarifies that the salaries of administrative, clerical staff, that they can be charged, that where they would normally be treated as indirect cost. This is clarifying that these costs may be charged off as direct cost to that federal award if these following conditions are met. And so they've got 4 conditions on that. So if you can determine that the clerical services are integral to the project or activity, that the individuals involved are specific to that project or activity, that the costs are explicitly included in the budget of your grant award to cover that cost. In this case, if they would be having the prior written approval of the federal agency, in our case, we have that prior written approval. And then that also, here's the important thing, that the costs are not also recovered as indirect cost. So we can't add that administrative assistant in our indirect cost pool, charge off half of her salary to indirect, and then charge off 100%, actually on the federal award. So that would be double dipping. And then paragraph D, and really we want to point out paragraph E is where the change is. So if you have costs of certain activities are not allowable as charges to federal awards. However, what this is saying in this section is if you have activities within your tribe, your entity, that would be determined to be unallowable cost to the federal award. But that it's a program or a service or a function that is benefiting from, it has activities that include the salaries of personnel, they occupy space, and they benefit from the indirect cost pool. Big example of, they have office space, they're getting maintenance on there, they get all their supplies from the central service supplies of the organization. They get the IT services that's supplied by the tribe. But if that activity is unallowable, what this is saying is you still have to include them in the indirect cost negotiations so that that program is paying for its fair share of indirect cost. So just to kind of back up, if you want everyone to look up in the definition, a little definition exercise, look up what the definition for indirect costs, and you'll notice that it also has in parentheses facilities and administration costs, or administrative cost. So that's the term that came into being a while back, and it has basically the same meaning. That if you say indirect costs specifically for institutes of higher education, it has the same meaning. It also means facilities and administrative costs. So the definition is just a review, refresh our memory on this, so we can talk about the next section. These costs are incurred for a common joint purpose benefiting more than one cost objective. And they're not readily assignable to one cost objective. We can't decide in an accounting office, they're supplying checks, they're managing the accounting for multiple federal awards. Emily, we got to go, hey, how much time are you spending writing checks out for this award, or how much time you're spending out for this award? And we go, hey, if you had to time track all that, the effort to do that is disproportionate to the results achieved. In other words, it's going to take more time for her to time track than the benefit's going to be. So that's why we put that cost in the indirect cost pool, so that we can then come up with a rate, and we can then apply that indirect cost rate, and we can charge that federal award and recoup the time for Emily's time working on all those federal awards. If it's done right, if we have the right direct cost rate base, then each federal award is going to pay its fair share. That's my rough and ready indirect cost 101. So it goes on to say, to facilitate equitable distribution of indirect expenses and all the objectives asserted, it may be necessary to establish a number of pools of indirect costs. So depending on how large your government organization is, you might have indirect cost pools for different functions. So a motor pool that serves multiple programs may be one example of that. Okay, so now we got that little background done. So let's go to 414. So let's see what has changed for us regarding, what's the new language for us regarding indirect costs. So here, paragraph C under 414, federal agency acceptance of negotiated indirect cost rates. The agency, this is making it clear that agencies are required to must, and we underline the word must, remember that should, must. Okay, so must be accepted by all federal awarding agencies. There are some exceptions to that. And so if there is any deviations, that's the mandate to the federal agency that they must notify OMB for any exceptions to that. Agency must implement, make publicly available the policies, procedures, and general decision-making criteria that their program will follow to seek and justify deviations from negotiated rates. So what this is saying is a federal, once you, with your cognizant agency, once you negotiate that rate, whatever it is, the federal agency must accept that rate. Just important, just to want to point out to you, because there's some changes. When we had OMB 87, we had different appendices for where we located the template for doing indirect cost proposals. So just wanted to point that out to you. They've changed their location, so now they are in the appendix of the entire 2 CFR 200. And so for the indirect cost rate proposals for nonprofits, it's in Appendix 4. State, local, government-wide central service cost allocation plans are in Appendix 5. And then most importantly for us, is for our tribes, is Appendix 7, is the state, local governments, and Indian tribe indirect cost proposals. And in doing our side-by-side of the appendices, they haven't changed at all. So verbatim, everything was the same right across the board, which makes it nice for us. Okay, and then 414, paragraph F on there. And this is the new thing that we talked earlier in the section on the types of awards and the requirements of subrecipients, the introduction of the 10% de minimis rate of modified total direct cost. So, what this means, if you've never had a rate, if you're a small tribe, you've never had an indirect cost rate, this is saying that you can get, or you have the option to take the opportunity to take a 10% of your total modified direct cost. So. We won't go into the definition, but modified total direct cost allows us to calculate things that would distort the cost. So, if we're paying we have a large contract, we would remove that contract from our direct base, so we're not charging administrative costs against an entire contract that's going to require, 1 or 2 checks written across it. Salaries. So if you want to take a look at that, that definition has not changed. So. But the main thing here is that, we have, if you haven't had the opportunity to have a indirect cost rate or negotiated rate, you have the opportunity to do that now at a minimum of 10%. There is an exception for tribes over 35 million. Not too many of our tribes that have that. But you wouldn't be able to use the 10%. You would be required to negotiate a rate and have an approved rate through your cognizant agency. All right. So if you use that de minimis rate, you would need to use it on all your federal awards until you actually then negotiate an approved rate. So again, you'll notice in here the language, some expanded language emphasizing the difference between direct and in cost, and making sure that we're not double charging. So we have to treat that consistently. We can't, in one federal award, put this as a direct cost, and then another put this in as an indirect cost. We have to be consistent, so we're not double charging the grant. The other last point here on this in 414, a non-federal entity that has a currently negotiated indirect cost. New language, you can apply for a one-time extension of the rate for a period of up to 4 years. So you would be locked in if you take that option. You're locked in for that 4 years. You wouldn't be able to go back and negotiate it. You have to keep that rate. And then at the end of that 4 years, then you could go back and renegotiate a better rate. So that's a new provision. And that's it for the basic general provisions and the changes that we've noticed that are going to be important to you as recipients for indirect costs. So We know this really applies primarily to our tribes that are recipients of the Indian Housing Block Grant, most of our TDHEs, I don't even think we know of any TDHEs that actually have a negotiated federal rate. So we'll talk a little bit about that. There is the option of for recipients, for pass-through entities, to take advantage of indirect cost, this 10% de minimis rate. And so that's kind of an important thing, but we'll talk about it in the next session. All right, that's it for session 7.